kind of annual returns do you consider to be good? It depends on what style of market play you're talking about, because if you're talking about a short-term day trading like style of market play, those returns are high. In fact, day traders don't look at returns because they're often trading with excessive amounts of leverage, and the return numbers just look ridiculous. So let me give you an example. A professional trader might have leverage as high as 100 to 1. So meaning $1 million can get the trader $100 million of trading. All right. And if I make off of the $100 million, if I make $1 million, I really made 100%. All right. Not 1%. So it's 1% based on my leveraged amount. 100 million is my leveraged amount. But my cash amount, the real money at risk, is the $1 million. And so I'm using $100 million to make $1 million, but that $1 million is 100% of the cash amount that I have in the play or in my portfolio. So in reality, I made 100%, not 1%. And so short-term oriented traders tend to use dollar amounts and not percentage amounts. All right. A trader can double his account in a single day if he's highly leveraged. All right. Now, if you are talking about longer-term play, let me throw some interesting numbers out to you. We just talked about Warren Buffett's borrowing money for free. Let's talk about the fact that Warren Buffett has become the most recognized, the most hailed, the most focused on, and the wealthiest professional market participant the world has ever known. He's done that with an average annual return over the past 40 years of about 15%. I'm going to repeat that. Warren Buffett became the wealthiest investor ever known to mankind with an averaged annual return of about 15%. So there you go. Now, it should be noted that Warren Buffett is playing with hundreds and hundreds of billions of dollars. And so 15% on that amount is truly impressive. And the consistency over time is even more impressive. Okay? An individual player should trounce Warren Buffett. As just to give you an idea, my wealth program, my wealth trading program has had annual returns of over 300% for the past decade. That's annual, over 300% for the past decade. Do you understand? An individual should be able to trounce Warren Buffett's record. That doesn't take anything away from Warren Buffett. It's just that the individual trader, the individual investor has the benefit of being more nimble. All right. We can be more nimble than Warren Buffett. We don't have to buy 88 million shares over the next seven months. We can buy right now. And for Warren Buffett to unwind a position and to do it without the world knowing has to take time. We don't need to take time. We can get in and out. And so our precision is sort of like that little speedboat versus Warren Buffett's Titanic trying to turn this slow, big, giant, clunky machine around and maneuver. Now, size has benefits, but it also has disadvantages. Our size has benefits, more nimble, but it has disadvantages too, where we can't push things around like Warren Buffett can. We can't influence things like Warren Buffett can. So I know I'm long-winded with this, but what is a good return? Listen, if you're beating Warren Buffett, you're doing okay. Now, let's understand some numbers here. Over the past 10 years, over the past several decades, the annual return, the annual return of the S&P has been about 11% with dividends included. That's important to understand. Not just the pure movement of the S&P 500. It includes dividends, or it assumes that all dividends paid are actually reinvested into the stocks themselves. So it gets to 11% over the past several decades with dividends included in the play, in your overall play over the past several decades. If you take dividends out, you're roughly around 7-8%. So 7-8% annualized return for the S&P 500 over decades without dividends, about 11% with dividends. All right, maybe it's a little higher, 8-9% without, 11% with. Now, Nasdaq has been a little higher, about 14%. All right, so 14% annualized over the past several decades. Now, over the past decade, those numbers have jumped up. So we've jumped up to about 14-15% on the S&P because of money printing over the past decade has accelerated. And because of money printing by the Federal Reserve having accelerated, the Nasdaq has jumped closer to 18%. So you've got 14-15 to now 18%. And those are what the new numbers are. So right now, in today's environment, if you're roughly doing 20%, you are beating the market. And that's the threshold, is to beat the market. Because if you're not going to beat the market, then what are you doing? You might as well just buy the market. If you're going to underperform the S&P 500, why not just buy the S&P 500? If the S&P 500 consistently beats you, you should not be trying to do anything other than get yourself into the S&P 500. If you're not beating the Nasdaq 100, then why are you individual stock picking? Just buy the Nasdaq 100 and be done with it, right? So those are always going to be your thresholds for market play. Can you beat the market? Now, when you get into the cryptocurrency field, right? Bitcoin being the king of all cryptocurrencies, being the only cryptocurrency as far as I'm concerned. Everything else is a technology project. So Bitcoin has two numbers I think it's important for everyone to understand. It has the KGRA number, which is roughly about 213% a year. So if we go all the way back to the beginning of Bitcoin's life, Bitcoin has basically a cumulative average annual growth rate of 213% a year. There is no asset that has ever existed in the history of life, in the history of the world. Not on this planet. I don't know about other planets yet, but this planet, no. Bitcoin, 213% a year, trounces. The next one is the Nasdaq, which I told you is now at about 17-18% a year. So 213%, 18% a year, there's no comparison, right? We've never had an asset class do this before. You understand? But the other number I think I need you to understand is the fact that it's a little unfair to use the very beginning years for Bitcoin because Bitcoin traded at zero. So if you go up even a fraction of a penny, that's 1,000%, or that's 100%. You know, so counting those early numbers skews the number really big. So if you just take the last 10 years, so we take 3 years off, right? Let's take the beginning 3 years out of the numbers. We're looking at 140% a year. Then that's first place, 140%. Second place is the Nasdaq, 17%. 17%, 140%. 17%, 140%. Guys, this is in a completely different galaxy. Now, you don't buy anything else except Bitcoin unless you think you can beat 140% a year. And if you can't beat 140% a year consistently, then what the heck are you doing? Just buy Bitcoin. If you can't beat these metrics, if you can't beat the standard, just buy the standard. That's investment trading economics 101. You only play individually yourself if you have the capability of beating the standard. If you don't, just freaking buy the standard and go to the beach